The United States outboard engine market didn't slow down. It shattered. In just 18 months, $6 billion in value vanished, leaving warehouses crammed with unsold engines, dealers scrambling to survive, and owners holding the bag. Manufacturers denied it. Dealers felt it first, but the truth runs deeper. Dreams of endless demand collided with exploding debt and rushed engineering. By the end, you will see why the collapse of an industry that once seemed unstoppable was always more than just a numbers game, and why no one saw the real storm coming. In 2021, the numbers told a story few could ignore. United States outboard engine sales soared past 330,000 units, a record, up more than 30% in a single year. Factory lines ran at full tilt, with major manufacturers pushing their plants to 95% capacity or higher. Some increased output by 50%, racing to keep up with orders that never seemed to slow. At the peak, warehouses emptied as soon as shipments arrived. Dealers across the country reported deliveries arriving weekly, sometimes daily, with mechanics scrambling to uncrate engines and prep them for buyers who had already lined up. A veteran technician in Florida described the rush. He said, "We were unloading trucks at sunrise, bolting engines onto skids, barely keeping up. It felt like it would never end." The pressure reached every corner of the supply chain. Purchase orders doubled, then tripled, as dealers tried to capture every possible sale. Spreadsheets tracked thousands of engines moving from ports to showrooms, with some dealers holding more inventory than in any previous year. Manufacturers counted revenue with each engine shipped, regardless of whether a buyer was waiting. The entire system stretched to its limit, fueled by the belief that demand for boating would only climb higher. This was not just a seasonal surge. It was a tidal wave that swept through every marina, every dealership, every factory. The industry had never seen numbers like these. The expectation was simple: the boom would never break. But every engine stacked in a crate, every extra truckload, carried a risk no one wanted to acknowledge. Bulk incentives changed the rules of the game. Manufacturers offered rebates and bonuses for dealers who placed the largest orders, sometimes promising thousands of dollars back on every engine if quotas were met. Contracts arrived with minimums that climbed higher each quarter, locking dealers into commitments they had never seen before. The logic was simple: order big, get rewarded. Miss the mark, lose your margin. The rush to stock up became a contest, with some dealers doubling or even tripling their usual orders just to stay ahead of the competition and secure their place on the manufacturer's list. Dealership managers signed off on purchase orders that filled entire warehouses, convinced that the surge would last. The numbers on the spreadsheets looked safe until reality caught up. By late 2022, some lots held more engines than they had sold in the past 2 years. Mechanics unpacked crates that no customer had requested. One veteran shook his head at row after row of shrink-wrapped outboards. He said, "We are not selling these. We are storing them." The pressure did not let up. Manufacturers counted every shipment as revenue, regardless of whether the engines ever left the dealer floor. Dealers who hesitated faced warnings about lost incentives or future allocation cuts. The contracts were clear: failed to meet the minimum, and the next year's supply could dry up. For many, the only way to survive was to keep ordering, even as the market began to cool. By the time the warning surfaced, it was already too late. Dealerships were locked into mountains of inventory, with no way out but to keep paying and hope demand would return. The risk was not just unsold engines, it was debt, interest, and the slow realization that the boom had become a trap. Sticker prices climbed with every shipment. In 2019, a 150 horsepower outboard might have cost $13,000. By 2024, the same engine listed above $25,000, sometimes cresting $35,000 for top-tier models. The average family looking for a weekend boat faced a price jump that doubled or even tripled their monthly payment. For many, the numbers simply stopped making sense. The pain was not limited to the sales floor. Mechanics, some with decades behind the bench, watched the repair landscape change almost overnight. New models arrived with digital throttle controls, encrypted engine modules, and proprietary diagnostics locked behind factory software. Gone were the days when a skilled hand and a basic toolkit could keep an engine running for years. Now, even simple fixes demanded expensive dealer-only equipment. Owners who tried to save money by doing their own maintenance found themselves locked out, forced to pay for authorized service or risk voiding their warranty. A veteran mechanic put it bluntly, "The old engines, you could fix with a wrench. These new ones, if the computer says no, you are done." Every extra feature added cost and complexity. For buyers, the promise of new technology quickly turned into a warning. The higher the price, the harder it became to justify the risk. The more complicated the engine, the less control owners felt they had. By the end of 2024, the market's confidence had started to crack. Engines sat untouched, not just because of the cost, but because the barriers to ownership and repair were higher than ever before. Every outboard engine stacked in a dealer's warehouse came with a silent passenger, a loan contract. Floor plan financing was the lifeblood of the industry. It worked like this. When a dealer ordered a new engine, the lender advanced up to 90% of the invoice price, using the engine itself as collateral. For the first 3 months or 6 months, all the dealer owed was monthly interest. In 2022, that meant a manageable bill. By 2024, as rates soared past 12%, the cost ballooned. 100 engines at $17,000 each meant $1.53 million borrowed. That is $15,300 a month in interest before a single engine sold. The real pain started with curtailments. After 90 days, lenders demanded a chunk of the principal, 10 or 15%, whether the engine had sold or not. Miss a curtailment, and the next one hit even harder. By the end of a year, half the principal could be due, plus interest every month. For dealers sitting on slow-moving inventory, cash flow dried up fast. One former dealership CFO described it, "Interest alone was up 60% in 18 months. One wrong quarter and the curtailment wiped you out." Contracts gave lenders broad power. If a payment was missed, default rates kicked in, sometimes 5% higher. Lines of credit froze overnight. Inventory could be seized and auctioned for pennies on the dollar. The math was unforgiving. Every unsold engine drained cash. Every loan payment cut deeper. In the end, the loans were built on the belief that every engine would sell in 90 days. When sales slowed, the trap snapped shut. Interest rates did not rise slowly. They jumped. In the space of 18 months, the cost of borrowing for marine dealers soared from just over 4% to nearly 13%. The numbers on monthly statements turned from manageable to crushing. A dealership carrying $1.5 million in outboard inventory saw its interest bill leap from $5,000 a month to more than $16,000, practically overnight. For some, the spike hit even harder. Contracts that once offered a cushion now triggered penalties. Lenders, spooked by mounting risk, rewrote the rules midstream. Curtailments accelerated, grace periods shrank, and audit calls became monthly instead of quarterly. Miss a payment, and the interest rate shot up 5 percentage points. Miss 2, and the line froze. Inventory that was supposed to be an asset became a liability, aging on the books while the cost of carrying it grew with every passing week. A former dealership chief financial officer described the moment the numbers stopped making sense. "We went from $9,000 a month in interest to $21,000 in less than a year. That is before we paid a dime of principal." Each curtailment demanded a chunk of cash, 10%, sometimes 15% of the original loan. due whether a single engine had sold or not. As rates climbed and penalties stacked up, even well-run stores were pushed to the edge. The math was simple but merciless. Engines that had once been a ticket to profit now bled cash with every statement. The pressure was relentless, and for many, survival was no longer about selling boats. It was about keeping the bank from locking the doors. In Michigan, the collapse wasn't theoretical. It was a chain reaction that started with a single phone call from the bank. A dealer group, once valued at $115 million, missed a curtailment. Within hours, lenders locked down accounts and activated remote inventory tracking. Automated emails demanded payment in full. The next morning, a team of liquidators arrived. Employees were told to leave their keys on the counter. Engines, some still wrapped in plastic, were tagged for auction. The lot was emptied in 3 days. Court filings show the lender recovered less than half the outstanding debt. With engines selling at deep discounts, no one could have predicted a year earlier. An economist who tracked the fallout described it as a textbook example of systemic risk. The entire market was built on the idea that inventory would never stop moving. The moment that belief broke, the financial structure collapsed in on itself. This wasn't just one business failing. It was a warning to every dealer holding aging stock on borrowed money. Lenders across the country, seeing the Michigan default, tightened credit lines overnight. Audits increased. Payment terms shrank. The Michigan case exposed the fragility of the system, how quickly confidence could turn to panic, and how a single default could ripple out, threatening the stability of an entire industry. The numbers on the spreadsheet were no longer just projections. They became the trigger for a nationwide reckoning. Rows of engines, each still wrapped in factory plastic, lined the auction warehouse like gravestones. Liquidators moved through the aisles, scanning barcodes and tagging assets, hundreds at a time. The inventory list read like a catalog of lost value. Nearly $85 million in engines, boats, and parts, all set to be sold off in a single week. Former employees stood at the back, silent, watching as years of work vanished under fluorescent lights. The bidding started slow, a handful of brokers and resellers raising paddles for lots that once represented a dealer's future. Hammer prices fell fast. One lot of 20 outboards, stickered at $480,000 just months before, sold for $162,000, barely a third of the book value. Crates destined for family marinas and charter fleets were now bulked together, snapped up by exporters and salvage firms. Each sale drove prices lower, the auctioneer's gavel echoing through the empty building. By the end, engines that once commanded $25,000 left for less than $10,000 each. The total recovered barely covered half the outstanding debt. For the people who built their lives around these machines, the auction was more than a loss. It was an ending, played out one bid at a time. Captain James kept a diary, short, tired entries scrawled after midnight. In January 2023, he bought a new outboard for his charter boat, financing $28,000, with the promise that the engine would hold its value. By the end of 2025, the resale market had collapsed. His engine, barely 2 years old, was now worth less than half of what he owed. The numbers did not add up. Monthly loan payments, insurance, and maintenance outpaced his charter income. Each week, James called brokers, hoping for a buyer. Offers came in at $11,000, sometimes less. To sell meant eating a $15,000 loss. To keep running meant losing money on every trip. He let 2 deckhands go in March, men he had fished with for years. The boat sat at the dock more often than not. James wrote that he was working twice as hard for half as much, and that nobody would buy his engine unless he ate the loss. Mechanics in the marina echoed his frustration. They watched as owners begged for trade-ins, only to be told their loans were underwater. The old engines, simple and reliable, became rare prizes. The new ones locked behind digital controls felt like anchors, dragging families and small businesses deeper into debt. For James, the crash was not a headline. It was a slow unraveling, measured in missed payments and quiet goodbyes. In the final months of 2024, the phone calls stopped. Dealers across the Midwest and Gulf Coast woke to silent inboxes, no new credit offers, no floor plan renewals, only terse notices that their lines were suspended. Some found out when their cards were declined for payroll. Others discovered the freeze when lenders demanded immediate audits and then locked online portals without warning. For many, it happened overnight. A single email arrived with the subject line, "Portfolio Review, Immediate Action Required." Regional banks and finance companies, once eager to underwrite inventory, vanished from the market. Internal memos later leaked and revealed a stark calculus: rising defaults, evaporating collateral, and a portfolio too risky to salvage. In some regions, all marine lending ceased in a single week. Dealerships that survived the first wave of closures now faced a wall. No credit to pay curtailments, no cash to cover interest, and no way to restock even if buyers appeared. Service departments went dark. Showrooms emptied as engines were repossessed or auctioned. One dealership chief financial officer summed it up in a late-night voicemail. He said, "They pulled the lines just like that. It does not matter how long you've been with them. No credit, no inventory, no business." The collapse was complete, not with a bang, but with a silence that stretched from bank headquarters to rain-soaked docks. The system that had fueled the boom simply shut itself off. Today, thousands of outboards sit unsold, while new loans keep the cycle turning. The price of overproduction is not just financial. It reshapes access, trust, and the future of boating for American families. As interest rates hover near decade highs and repair restrictions lock out owners, the waters ahead remain uncertain. The lesson lingers. Unchecked growth destroys more than balance sheets. Thank you for watching. Share your perspective below.